So we often talk about the AI boom, this incredible force. But have you ever really stopped to think about the massive sort of hidden infrastructure that actually powers it?
It's immense, truly.
Or, how fast a company can go from being maybe less known to absolutely central in tech?
Right, the shifts can be incredibly quick.
Well, today we're doing a deep dive into supermicrocomputer SMCI. Maybe not a household name for everyone, but they are absolutely critical to this whole AI and data center explosion. They're basically building the backbone, the physical stuff.
Yeah, hardware foundation.
Our goal here is really to give you a clear, full picture of SMCI. We'll unpack their recent financials, try to demystify their business model, which is pretty unique, and look at the headwinds and risks they're facing.
Both short and long term.
Exactly. And we'll dig into the leadership, too. Who's running the show? Are their interests aligned with shareholders? Who actually owns this company?
Crucial questions.
And just so you know, all the insights we're sharing today, they're pulled directly from SMCI's latest earnings reports, business descriptions, corporate info, shareholder data. We're aiming for an unbiased, fact-based view here, just laying out the information.
Right, sticking to the sources.
Okay, so to really get this, let's start right at the beginning. What exactly is supermicrocomputer, and how do they slot into this huge AI and data center landscape?
Well, at its core, SMCI designs and builds high-performance server and storage solutions, but they have a real focus on energy efficiency, which is, increasingly important.
Especially for AI workloads.
Exactly. They're key suppliers for enterprise clients, cloud providers, and, yes, especially AI applications. What really sets them apart, I think, is their building block architecture.
Okay, what does that mean in practice?
It means their systems are modular, highly customizable. They can essentially piece together servers very quickly to meet really specific customer needs. Think tailor-made machines, whether for a massive data center or like a specialized research lab running AI models.
So flexibility and speed.
Precisely. And their product range is broad. You've got complete rack mount servers, blade systems, multi-node setups, and critically, those GPU servers, which are just vital for the heavy lifting AI requires. But they also do subsystems like motherboards and chassis.
But it sounds like the focus is shifting more towards the complete package.
Absolutely. That's a key point. In fiscal 23, something like 92% of their net sales came from complete server and storage systems, only 8% from components.
Wow, 92%.
Yeah. It shows they're not just selling parts, they're delivering full integrated solutions ready to go. That's a much higher value proposition, gives them more pricing power, stickier relationships.
Makes sense.
And they're global. Over 1,000 direct customers, 100+ countries. And their manufacturing muscle is pretty significant. They can churn out around 5,000 complete server racks a month.
5,000 a month.
Yep, including over 2,000 liquid-cooled racks. And that liquid cooling is becoming super important for handling the heat generated by dense AI computing.
So, okay, they are literally building the brains, the physical hardware, driving the AI revolution. That's a fundamental, critical role.
It really is.
But despite being so central, you mentioned their latest earnings report, Q4 25, hit some turbulence, especially around profitability. What's happening there? Is it just a blip or something more?
You've hit on the key tension, really. So looking at that Q4 ending June 30th, 2025, yes, revenue growth year over year was strong, $5.8 billion in sales, up 7.5%.
Still growing.
And the full year, FY 2025, was impressive. $22 billion total revenue. That's 47% annual growth. Explosive by any standard.
Right.
However, the challenge, as you said, was margins. Gross margin dipped to 9.5%. That's down from 10.2% the year before.
Yeah, squeeze.
Management pointed to a few things: higher component costs, which is a persistent issue in this industry, increased costs from tariffs, and significantly, a big jump in operating expenses, up about 22.6% year over year.
Ouch. Why the OpEx jump?
Mostly increased headcount and salaries. They've been scaling rapidly to meet demand, hiring people, engineers, manufacturing staff.
Growing pains, maybe?
Sort of. And all that flowed down to the bottom line. Net income was $195 million. GAAP EPS, that's the standard accounting measure, was $0.31, down from $746 a year ago. Even their non-GAAP EPS, which often smooths things out, was lower.
So how did management explain this drop in profit despite rising sales?
Well, They attributed a big part of it to those tariffs we mentioned, and also some last-minute specification changes from a major customer. Apparently, this pushed back when they could actually recognize the revenue for some large orders.
Timing issues.
Timing issues, exactly. They also mentioned other big orders were delayed simply because of broader economic uncertainty, customers being cautious, but they do expect those orders to close in the coming quarters.
Okay, so potentially deferred revenue, not lost revenue.
That seems to be the message. And despite these issues, their cash position looks solid. They generated $864 million in operating cash flow in Q4 alone and ended with a $5.2 billion cash balance. They do have debt, about $4.8 billion, but still a strong cash cushion.
Right. But the market didn't like the outlook, did it?
No, that's what really seemed to spook investors. Their guidance for Q1 of fiscal 26 was weaker than expected. Revenue projected between $6.11 and $7 billion. Okay. But GAAP EPS guidance was only $0.30 to $7.42.
And analysts were expecting.
Closer to $0.60. So a significant miss versus expectations. And that led to the stock dropping sharply, almost 20%, right after the announcement.
Oof.
Yeah. But it's interesting, despite that guidance and the market reaction, CEO Charles Liang sounds incredibly bullish long-term. He actually raised their full-year FY 2026 revenue target to at least $33 billion.
$33 billion, that implies, what, 50% growth again?
Around that, yeah. The thinking is those delayed projects will come through and the underlying demand remains incredibly strong.
That's quite a contrast. Strong growth, but margin pressure, a weak outlook causing a stock hit, yet underlying confidence. It paints a complex picture. Huge potential, clearly, but definite challenges.
Absolutely.
So what are these bumps in the road? Can we separate the temporary issues from the more, structural long-term risks?
Yeah, that's a good way to look at it. On the short-term or maybe temporary side, you've definitely got those U.S.-China trade tariffs hitting costs. Plus general supply chain cost increases for components and logistics. Management was pretty explicit about that impacting the recent quarter.
Okay, external pressures.
Right. Then there's the lumpiness of big customer orders, a major client changing spec slate, others delaying due to economic caution. That creates quarterly volatility. But again, the expectation is these orders aren't lost, just shifted.
So timing again.
Timing again. Another temporary headwind has actually been their own success demand outpacing their production capacity. They faced some capital constraints in scaling up fast enough, but they are addressing this. Investing in a new factory, expected to come online in 2025, should help ease that bottleneck.
Makes sense. Any other short-term things?
Well, there's the regulatory and legal overhang from those short seller allegations back in August 2024. That led to DOJ and SEC subpoenas, some securities litigation. Management strongly denies any wrongdoing, and importantly, they did catch up on their filings eventually without needing to restate financials. But it definitely created uncertainty.
Right, that governance cloud.
Exactly. And finally, just the general global economy. High interest rates, currency swings, potential slowdowns, those can always dampen IT spending.
Okay, so those are mostly temporary or being actively addressed. What about the longer-term, more structural risks? The stuff that might not go away?
That's where it gets maybe a bit more challenging. Competition is intensifying. You've got giants like Dell, HPE, Lenovo, all vying for data center business. And as SMCI targets bigger customers, there's pressure for volume discounts. The risk of commoditization, where margins get squeezed because everyone's offering similar stuff.
The race to the bottom on price.
Potentially, yeah. Then there's technology risk. This field moves incredibly fast. What if the hyperscalers, the big cloud companies, decide to design even more of their own servers in-house? Or what if some entirely new computing approach emerges? SMCI has to constantly invest in R&D just to keep up with new CPUs, GPUs, cooling tech. It's relentless.
Constant innovation needed.
Absolutely. Geopolitics is another structural risk. Tensions around Taiwan, U.S.-China relations impacting chip exports like GPUs going to China, that could disrupt supply chains or raise costs significantly, even with their efforts to diversify manufacturing beyond Taiwan to the U.S. and potentially Malaysia.
Supply chain vulnerability.
Definitely. And related to that is reliance on key suppliers. We saw component shortages hit everyone a few years back, and when suppliers like NVIDIA dominate a critical component like high-end GPUs, they have enormous pricing power.
Squeezing SMCI from the supplier side, too.
Could happen. And finally, we have to circle back to corporate governance. Those past accounting issues from 2015, 2017, the NASDAQ delisting, the SEC fine, that history exists. And the more recent filing delays in 2024, while ultimately not leading to restatements this time, still raise flags about internal controls.
So even though they fixed the recent issue, the history makes investors watchful.
Exactly. It suggests, perhaps, control failures or process weaknesses rather than outright fraud, which is a huge distinction. But it means ongoing vigilance is needed. They're working on it, hiring compliance people, expanding the finance team. But it's a risk factor investors track.
Okay, so a lot of external pressures, internal scaling hurdles, and the shadow of past governance issues they're working to fully overcome. Given all that complexity, how does this translate into managing their money? Let's unpack their cost structure. What does that tell us?
Yeah, the cost structure is really revealing about their profitability drivers. The biggest chunk by far is variable costs, specifically their cost of goods sold, or COGS.
That's the parts, right?
Yeah.
CPUs, GPUs, memory.
Exactly. Components and materials. This typically makes up somewhere between 85% and 90% of their revenue. And because it's so dominant, their gross margin is incredibly sensitive to swings in component prices and those tariffs we talked about.
So managing procurement and supplier costs is absolutely critical for them.
Paramount. A small change in component costs has a big impact on the bottom line. Their fixed or maybe semi-fixed costs, what they call operating expenses or OPEX, are a much smaller slice.
That's R&D, sales, admin.
Right. R&D is usually maybe 4-6% of sales, sales and marketing just 1-2%, general admin 1-4%, so single digits typically.
That implies pretty significant operating leverage, doesn't it?
It does. When revenue grows rapidly, like it did between fiscal 21 and 23 when it doubled, those fixed OPEX costs become a much smaller percentage of the total revenue. OPEX dropped from 13.2% of sales down to 7.3% in that period. That leverage effect can really boost profitability during growth spurts.
But the flip side is true too, right?
Right.
If growth slows.
Exactly. If growth slows or reverses, those fixed costs don't shrink as quickly, and that can hammer margins. Labor costs fit in here, too. They have over 4,000 employees. Some labor is in COGS, manufacturing, some in OPEX, engineering, admin. We saw that 22.6% jump in compensation recently, weighing on earnings. While labor can act like a fixed cost short term, over the longer run, hopefully, existing staff become more productive as volume grows.
So the key takeaway on costs is
profitability is overwhelmingly sensitive to managing those variable component costs in COGS. And because OPEX is relatively fixed, SMCI really relies on sustained volume growth to drive profits. It's a volume game for them to a large extent.
that gives us a really clear picture of the financial dynamics. Okay, so who are the people actually steering this ship through these, high growth but also choppy waters?
Yeah.
And crucially, are their interests really aligned with shareholders?
Well, leading the charge is the founder and CEO, Charles Liang. He's been at it for over 30 years, really the visionary behind the company.
Decades of experience there.
Absolutely. He's supported by CFO David Weigand, who came on board in 2018, became CFO in 2021, and has been credited with significantly improving financial reporting processes after those earlier issues.
Bringing in needed financial discipline.
Seems so. And co-founder Wally Liao is also back, focusing on business development and strategic partnerships since 2021. The board has 10 members, a mix of insiders like Liang and another co-founder, Sarah Liu, plus independent directors. And importantly, remember they appointed Susie Giordano in August 2024 to lead that special committee looking into the short seller claims. That signals a move toward more proactive governance.
Addressing concerns head on.
Right. Now, track record-wise, management has definitely delivered on ambitious growth. They blew past their $10 billion revenue goal, hit $22 billion in FY25. They clearly know how to execute and capitalize on the market opportunity.
Operationally strong.
Yes. But, as we've discussed, the financial reporting side has had those historical blemishes. The 2015-17 issues, the recent 2024 delays. While the latest round didn't lead to restatements, which is key, it still highlights the critical need for robust internal controls. They seem to be taking it seriously, hiring compliance staff, building out the finance team. And Liang, while known for being optimistic, has been open about the recent challenges like customer delays and tariffs.
So it sounds like maybe a journey from some past operational focus, sometimes overshadowing controls, towards a more balanced approach now. Stronger controls, more transparency.
That seems to be the trajectory, yeah. Addressing those administrative weaknesses seems to be a priority.
Okay, so how does their own skin in the game, their financial stake, tie into all this? Does it really lock their interests with other shareholders?
That's a really important piece for alignment. Charles Liang himself is the largest individual shareholder. He owns about 9.1% of the company.
That's significant, worth billions.
Billions, yes. And what's really telling is his official salary is just $1 a year. His compensation is heavily weighted towards performance-based stock awards. His personal fortune is directly tied to how SMCI stock performs.
Can't get much more aligned than that.
Pretty much. And combined, all insiders, founders, executives own roughly 13.9% of the company. That's a very solid insider ownership block, giving them strong incentive to maximize long-term shareholder value.
What about their buying and selling activity?
Well, historically, insiders, including Liang, were actually net buyers during dips, like back in the 2018 turmoil. Generally, they tend to hold their stakes. Liang hasn't sold significant amounts recently. We have seen some directors take profits more recently, which isn't entirely unexpected after such a huge run-up in the stock, but the core founder ownership remains strong.
Okay, and capital allocation, buybacks, dividends.
No dividends, which is typical for a high-growth tech company reinvesting heavily. They did have a share buyback program authorized $200 million back in August 2022.
Did they use it?
They did. They bought back $150 million worth in fiscal 23, and the timing was pretty fantastic in hindsight. They bought about 15.5 million shares at an average price of around $9.65, post-split.
Wow, $9.65 compared to where it went later. Great timing.
Incredibly well-timed. That program expired in January 2024, though, and more recently, with the stock at highs in March 2024, they actually did the opposite. They raised capital, about $600 million, through an equity offer.
So opportunistic, buy low, issue high.
It looks that way. Flexible approach, prioritizing growth investment but willing to return cash via buybacks when the price is right and raise capital when the market's offering attractive terms. And the value creation overall has been immense. About $1.1 billion in retained earnings between 2015 and 2024 helps fuel a market cap increase of something like $45–50 billion. That implies really high returns on the capital they reinvested.
That is a powerful incentive and track record. Okay, beyond the insiders, who else owns significant chunks of SMCI, and what does their presence tell us?
Well, outside of that 14% insider block, the biggest holders are the large passive institutional investors. You know, the usual suspects.
Vanguard, BlackRock.
Exactly. Vanguard holds about 10.8%, BlackRock around 6.8%, State Street maybe 3–4%. These are mostly index funds.
So they generally vote with management?
Typically, yes. Support rates for directors and say-on-pay are usually very high in the 90s. They exert influence more through quiet engagement, private stewardship, rather than public fights. Although sometimes you see slight caution, like maybe lower support for increasing equity incentive plans, but generally supportive.
What about active funds? Any well-known activists or value investors involved?
That's actually one of the interesting parts of the story. There aren't many prominent activist names, and for a long time you didn't see super investors like Buffett or Klarman with big positions.
Why not? Governance concerns, maybe?
That could certainly have deterred some classic value investors early on, but some did see the opportunity. A firm called Disciplined Growth Investors, for instance, started buying back in 2018–2019 when the price was incredibly low, maybe $1.50 post-split. And apparently, they still hold a significant position, having ridden that massive wave up.
Incredible return for them.
Huge. Another firm, GMT Capital, seems to have bought in early 2023, maybe around $5–8 post-split, and then trimmed as the stock soared. But many classic value types likely missed it or stayed away.
So the shareholder base has shifted over time.
Dramatically. By 2025, after the stock's meteoric rise, many early value investors who got in low have likely taken substantial profits. The dominant holders now, besides insiders, are those big passive funds and likely more growth-oriented or momentum investors who bought in during the AI boom. SMCI essentially transformed itself in the market's eyes.
From what to what?
From, an overlooked, maybe slightly troubled, low PE value stock into a premier, high-growth, AI-driven momentum name. It's been quite the journey, rewarding investors who are patient and willing to look past the initial risks.
That is a remarkable transformation. Okay, so wrapping up this deep dive, it's crystal clear. SMCI is a vital player in the AI hardware space, experiencing phenomenal growth.
Undeniably.
But also, as we've really unpacked, navigating a complex set of challenges. Short-term things like supply chains, tariffs, order timing, and longer-term risks like intense competition and the need for constant innovation.
And that governance aspect they're improving.
Right. Management, led by the founder, has shown strong operational skill, and critically, they have that massive personal stake aligning them with shareholders. Plus, we're seeing that increased focus on controls and transparency. The stock's incredible run really reflects this whole story from value play to growth darling.
A real case study in market perception shifts.
Definitely. And maybe a final thought for you, the listener, to chew on as you think about SMCI. In this world where AI demand feels almost infinite right now, how long can the companies building the physical infrastructure, the SMCIs of the world, really sustain that competitive edge and those profit margins? When does commoditization truly bite? Or when might the next technological leap disrupt even today's leaders? What unseen risks might still be hiding under the surface of all this exciting growth?
Good questions to keep asking.
Absolutely. Keep digging, keep questioning. Thanks for joining us on this deep dive. We'll see you next time. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. Like and subscribe us on Apple, Spotify podcast, or YouTube channel. Deep Value Investing. Don't forget to take the book list of value investing from the episode description. And to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.